Hi, good evening, everybody. Can you hear me? I can hear me. Don't mind type a one there so that I know that everyone can hear me. Okay, good. Okay, great. So, okay, now it's 8 o'clock. Okay, we'll just start. Okay, and don't wait for the rest. Okay, welcome for this evening webinar. Okay, we'll talk about data center REITs. Okay, along the way, you all have any question? Just type on the chat box. Okay, then I'll try to answer you along the way. Okay, but please ask question pertaining to this evening webinar. Okay, okay, so that we can be more direct on that. Okay, before I start, this is a standard disclaimer. Okay, what I share with you is for your information. Do remember to do your own due diligence, or in that we can also contact our Jurong East team. Okay. Just some update. Our investor center already open and is now located at Westgate Tower level 10. So if you want to contact us, actually you can look for us at Westgate Tower level 10. But at current COVID situation, we can only meet you in a by appointment basis. That means you must call us before you come. Okay, because we cannot have overcrowding situation in the office. Okay. For those that haven't know me, I think most of you actually are my graduate. Some of you may never, maybe, I think only minority of you have seen me for the first time. Okay, just some brief, fast introduction about myself. Okay, I'm a trainer for IBF accredited program where I conduct this flagship course called Lifetime Income Mastery. Okay, where 90% of the course fee will be pre-funded by IBF. For those that don't know what is IBF, IBF is Institute of Banking and Finance, which is directly under MAS. Indirectly, you can say 90% of the cost fee is funded by the government. Okay, so you need to come out with 10% of cost fee for attending the course. This is a summary of me. Okay, Darren Chu here. This is, I think it's more than 15 years already in this industry. I lost count. I joined this industry in 2005, 2006, no, 2005 November. Okay, so I think more than 15. Currently I'm the financial services director in Philips Securities, taking charge of the investor center at Jurong East, and our team have grown to close to 30 of us, stockbroker and financial advisor. So in case anyone want to make a career change to this industry, can talk to me. I also work as an engineer for 10 years before I make a career change to this industry. Okay, so 10 years as an engineer, then come to this industry for more than 15 years already. So it is possible for you to make career switch along the way. Okay, so this is a simple nutshell about me. Okay, this is just a brief update for those that have not converted your prepaid account. Okay, prepaid account to cash fast account. You can do so as and when you want. Okay, I think you take within 1 day, you'll be approved already. So this is something you just need to take note on that. Okay, and for the cash plus account, right, a lot of people thought that it's only because of the low fee, but do take note, you also can invest using your CPF money. Okay, CPF, that means that if you have buy shares using CPF SRS account, in the past you have to use a cash management account where you need to pay a higher brokerage commission. Okay, now you can use the cash plus account to trade your CPF and SI shares, and this is a commission you pay instead of this commission. Okay, what happened that you have already bought CPF or SI share in the past? Okay, even can be bought in other brokerage firm. Let's say you bought in EOB KN or make using DBS vehicles to buy your CPF or SI share. You can also sell it through the cash plus account. Okay, so this is something you need to think, because we understand that a lot of people not aware on that. They only thought that cash plus account when you buy cash, but you can also use your CPF and SI fund to trade. Okay, and this is just example, and you only pay 0.08% commission. No, there's no minimum, no platform fee. That means there is no hidden cost for using a CPF or SIS fund to buy. And I think this is the only platform, if I know, this is the only platform in Singapore that allow you to trade CPF and SIS fund and only pay 0.08% commission, or 0.08% of the commission with no minimum commission. You find any other platform that allow you to trade CPF or SIS money, you with this brokerage commission, do let me know. Okay, so like this, we know that what other competitor is, but currently, based on my knowledge, don't have. Okay, so for drawing this client, if you are not in our Telegram group, okay, please just contact this number. Okay, I think most of you are in the Telegram group, so they know about this webinar because we post on our Telegram group. And you're a regular investor, you can join our premium group. Okay, also please contact the number again. So this is a number for you to contact. This is our drawing team phone number. Please don't call me to add you to a Telegram group, because I call me, I'll forward to them also, forward to my team member to add you in. So just contact them directly and the account matter. And for those that are new, or for those that you got friend want to open an account with us, you can scan this QR code and send the link to them. Just make sure they key in PS1 towards the end. Okay, then they will become our client. So now, without further ado, let me just kickstart. Okay, today's webinar. Okay, today we're going to talk about data center. Just for the benefit of those that are very new to REITs, I just do a very fast introduction of what is actually REITs is. Okay, for those that are experienced on REITs investment, please just bear with me. REITs is a collective investment scheme that pool money from investor, okay, to buy properties. So when they pool money, they need something called a REITs manager that manage this pool of money and the property itself. So when they collect money from the investor to invest, they also borrow money from the bank at the same time. And what they do, they go and buy properties. And I always emphasize that they will buy mature property. So if you happen to see any REITs manager go and buy a property that just TOP one, just be more careful on that. Okay, you may want to ask what funny thing are the REITs managers trying to do. Okay, because you see they'll buy mature property, and most of them will buy after one rental reversion. What do you mean by one rental reversion? Means that they buy a property that's a TOP already, then they let it run for a while. Okay, run for a while, then maybe one rental reversion, that means like 3 years later. 3 years later, there's a rental renewal come already. That means the property become more mature already. Then they do a rental reversion. Then at the point of time, then the risk manager may want to consider to buy the properties. Okay, so this is just one example. One classic example is South Point, North Point City. North Point City got South Wing and North Wing, right? We know that North Point have been around for quite a while under Fraser Centrepoint. Now that Fraser Properties expand the South Point, okay, South Wing over, but South Wing is pretty new, which is why it's not under the REITs. Which why not under REITs. So you take a while for the South Wing to be more mature, then Fraser Centrepoint will most likely will take over on that. So this is what we mean by REITs manager will buy only mature property. They don't really buy South Wing where just developed. Okay, where you see the REITs manager don't do that. And because of what they do in these aspects, thus when they buy the property, immediately got rental income. Okay, immediately got rental income. And what they do, they only pay the bank interest. They don't pay the bank principal, which resulted you in having dividends. Okay, the REITs manager don't take your rental income to pay the loan. Okay, they don't pay the loan using a rental income. If they do this, I think they will be whacked during an AGM. They will never do that. So they only pay interest, which is why the loan is always there. Okay, that means the debt is always there. Very different from what you buy properties. Okay, where you need to pay down the loan. So the risk is constantly and perpetually forever on that. Okay, and because of that, then you got negative cash flow. And then you got positive cash flow and you got dividend. Not like we all buy property, you need to pay the loan. Sometimes we got negative cash flow. Okay, and these are all the various REITs in Singapore. So we got about 38 of them. So these are all the REITs where we got different category: retail, office and commercial, hospitality, industrial, specialized, healthcare, diversified. Why diversified? Because it encompasses more than one asset class. Just like Mapletree Commercial Trust, got the Vivo City, which is under the retail group, and got the office building is under the office commercial. So thus you can't classify them under retail or office and commercial. So they are being thrown into the commercial aspect. Okay, so today our focus, then we'll zoom into this thing called industrial REITs. Okay, why industrial REITs? This is the list of industrial REITs. okay, listed in SGX. But among these industrial, you will see Fraser Logistics and Commercial Trust, which is actually classified under diversified. Okay, why they are classified under diversified? Because it was a merger between Fraser Logistics and Fraser Commercial Trust. Initially, Fraser Logistics is under industrial REITs. When they merge with Fraser Commercial Trust, so they are lumped together. However, Fraser Logistics is still the major stakeholder. Okay, the logistics one is still the major contributor. Thus, you can also put that under them as a logistics REITs side by side to compare, where a lot of people compare them with Mapletree Logistics, but it's not really an apple to apple comparison, as they still got a commercial side, the office building, where Mapletree Logistics don't have office building. And Capital DC is purely data center. Okay, so it is a unique REITs that only run data center in the past. Okay, but as time passed by, more and more other REITs will want to go into data center asset class. Okay, thus data and Capital DC may not be the data center REITs that you want to go to in future. That means you want to buy a REIT got data center, not necessary to buy data center. Not necessary to buy Capital DC. Okay, is what we're going to talk about in today's session also. Okay, so let's look at performance. Let's look at the industrial REITs performance. This is as of 31st of August, okay, 2021. We can see that Capital DC is the top performance. Okay, top performance. The number two is Mapletree Logistics, and followed by Mapletree Industrial Trust. Okay, what does this performance mean? Do think no, this is called total annualized return. Okay, total annualized return. What does total annualized return mean? That this is include capital gain plus dividend. Okay, capital gain also can be include capital loss. Okay, which why you see ESR only give you 3.6%. You can see the dividend yield is not lower, right? But because there's capital loss, so net you only earn 3.6% over the 3-year period. This data is from iCheck. So despite Capital DC, we know that this year data center REITs, especially Capital DC, was one of the worst performing REITs. Okay, but despite that, they are still number one. You will hold them for 3 years. Okay, despite this year, they actually year to date they are negative. You still make 28% return per year. Okay, let's drag the timeline longer. 5 years. Who is the leader? Capital DC. Still Capital DC. It's 21%. What does 21% mean? Means you buy Capital DC 5 years ago. Today, you make more than 100% return. In terms of dividend, as well as dividend, all this. So the rank number 2 is still Mapletree Logistics Trust. Rank number 3 is still Mapletree Industrial Trust. So the top 3 for 3 and 5 years never change. Okay, despite I think a lot of you will be aware that these 3 REITs have been coming down this year. Okay, which later I'll talk about that, which maybe also become an opportunity for people want to invest long term. Is it a good time for you to slowly buy them up? Okay, since they are dropping quite a lot now. Okay, so this is what we'll talk about towards the end of this session. Okay, now we zoom into data center REITs. Okay, for those that just joined, if you've got any question pertaining to today's topic, you can just type on the chat box. Okay, then I'll answer it along the way. Okay, don't wait until the end, then you type on that. But please don't ask me what to buy tomorrow lah. Okay, then I'm not supposed to make a stock call in this webinar. You want to ask me about specific counter, you can just WhatsApp me. Okay, I think most of you will have my contact number. You can just WhatsApp me directly. Okay, so now let's move on to talk about the REITs. So the first REIT first data center related REITs we're going to talk about is definitely okay. Before we talk about it, we need to take note. When you look for industrial REITs, what should you look out for? Okay, so we look out for industrial that is a future one. That's why we call the new economy. So you may heard of this word called new economy. Quite common going forward. Okay, new economy. That's like Capital Retail China Trust. They have changed them for cost Capital Land China Trust, and they have saying that they're going into the new economy. They are not going to shopping mall alone. Shopping mall only contribute about 30. Going next 5 years, shopping mall will be trimmed to 30% for CI's Capital Land China Trust. the new economy will contribute 30%. Okay, so what do you mean new economy? Logistics, business park, high specification building. This is the new economy. So you want to buy industrial REITs. You have to make sure that they are focused to be on not all, but should be on either one of them. You cannot expect Mapletree Logistics Trust to focus on business city or data center because that's not a mandate. But in general, a diversified logistics, they should focus on this, not the traditional JTC flatted factories. Okay, so this is what you need to look at. A risk, whether do they have growth potential in the next 3 to 5 years. The risk manager should be focusing on this, then there is a higher potential for them to grow. If they still focus on the Singapore JTC flatted factory, 30-year lease expire already, then this is something you will want to worry about that. Okay. Okay. Yeah. Okay. So this is one thing to think of. Okay, there's one question. How will coming interest rate affect this REIT's performance? Actually, don't really worry about too much about interest rate. On that aspect, all the REITs already know that interest rate should go up, will should come down, will should go up, will should come down. So actually indirectly, they have know how to manage it. And a lot of them actually do their loan in fixed rates. That means they get their, just like take a housing loan that you may ask for floating or fixed rate. A lot of them are looking at fixed rates. Okay, so actually indirectly, they are handling the interest rate. And also it's not so straightforward on handling interest rate. Also, a lot of them have foreign currency, just like Mapletree Logistics Trust. They got a lot of property overseas. So besides interest rate, they may also need to do currency hedging. So it's more than one factor in that aspect. So how can you know that whether can the REITs handle all this? So I always recommend buy REITs that have a longer track records. If the REITs have a long track record, means they actually have managed, no matter, no, interest rate is just one part. They'll manage other things. So it's more of a performance that we want to look at on all this aspect. Okay. So this is something to think on that. Okay. And what's the best time to buy REIT? Best time to buy REIT when there's a dip, when there's a big dip. You ask me when is the best time, just buy it when there's a dip, which now actually October, I think there's a lot of opportunity. Okay. There's an opportunity for you to buy REITs. Okay. So can China Evergrande, how it affects Singapore and the US market? And this is our today's topic. Today's topic, we need to talk about data center REITs. Okay. Okay. So this is all drop. Nothing to do with US. Okay. So this is something to think on that. Okay. Now let's move on and let's talk about. So please focus your question on data center REITs itself. If not, I think we can ask anything. Then after this webinar, we're not able to continue. Going forward, I'll go do other seminar like ask me anything on certain topic. Then the one actually you can ask a lot of questions. I'm going to do some webinar going forward, like ask me anything about ETF or unit trust. And then that time you can just ask me anything related to that. Okay, now let's move on to the data center REITs. So the first REITs we're going to talk about is definitely Capital DC. Okay, it is the data center, it's the REITs that everyone want to buy data center. They think it's Capital DC. So how is Capital DC? Currently, this is based on their latest report. They got 19 data center, but do take note, all this number is dynamic. Okay, it's dynamic. We will not, or it can come down also, and it can go up. What do you mean come down? We know that Capital DC has sold off one of their data center in Australia. Okay, but they go and buy another data center in Netherlands. So indirectly, sometimes become control. So the number is dynamic, but ultimately, the key part when you look at REITs, this number has to go up. Okay, do take note. The number have to go up. If the number is dropping, okay, this is something you need to be careful. The number there's only one direction for number of property a REIT hold is up. It should not come down. It should only go up. So same thing, the AUM should only go up, should not come down. Okay, so this is key thing when you talk about REIT. So indirectly, their market cap will only go up. So when you see a REIT, there's anything like coming down, and maybe that may be a warning for you. Okay, to lay a closer, they have to go up. So Capital DC now has around 19 data center. And where is their data center located? Okay, so they are starting, you can see they are focusing on Europe, okay, where they got property in UK, Ireland, Netherlands, Italy, Germany, okay, and they also have data center in Australia, Malaysia and Singapore. Okay, Malaysia and Singapore. And China is their new venture. Okay, new venture. So they are actually mainly in Singapore, Malaysia, and Australia. Then they go to Europe, and ultimately and for last year, they are very quiet during the COVID period. They are very quiet in buying properties. They didn't do any new acquisition in the past 1 year until recently, a few months ago. Then they start to buy property in China and one property in Netherlands and sell one property in Australia. Okay, so this shows something in the REITs. During a pandemic period, where you can see other REITs are able to go and buy properties overseas. They go and look for cheap sales and buy, but Capital DC are not able to do that. Okay, so this is something you just need to think note of that. So why last year there's a lot of travel restriction, all these things, but what other REITs can do that and they can't do? So this is something you just need to think note of, okay, on this aspect. Okay, and next is look at their balance sheets. Okay, so we can see their balance sheets. This is their property. They are a $3 billion, $3 billion. When term of REITs, right, I always talk about size. Okay, I talk about size is a lot. Towards the end, I will re-emphasize on this size. Do remember these REITs have only investment property worth 3 billion. A lot of people thought billion is a lot, but when come to REITs, okay, when come to REITs, billion dollar is to be the own entry level, okay, to be a REITs. So if a REITs is a million, it is considered small. Just like when you buy stocks, you want to buy big cap stock, you don't want to buy mid cap or even buy penny, right? Okay, so million, sometimes it go to stock related, it can be like penny stocks. Okay, so we want a REITs to be at least cross $1 billion marks in terms of property aspect. And this REIT I passed the $1 billion marks, but it's on the lower side of $1 billion, is 3 billions. Okay, and another thing we want to look at is premium over NAV, premium to NAV. So the REITs premium, okay, now is 105%, but look at 31st of December, it's 136%. So a lot of people say that it is expensive, but now actually it has become cheaper. Okay, and today I think it is even cheaper. Okay, because the price have fallen further. I think the price today closing price is about 238. Okay, later look at the chart again. So okay, but please don't expect the premium. Okay, please don't expect Capital DC to go to on a discount. Okay, discount to NAV. Unlikely to happen. If they go to a discount, actually it's disaster. Okay, it's disaster. At the point in time, I think you should run away rather than buy the REITs. Okay, what do I mean by that is when looking for a good REITs, especially at current market environment, current era, premium REITs usually will perform better. Okay, especially REITs need to grow. They need to grow. A premium REIT will always result in a yield accretive acquisitions. A discount REITs will usually result in yield dilutive acquisition. So for retirees, actually, I always focus that you should buy REITs at a premium. Okay, REITs at a premium. Just like you go shopping, why the branded bag are so expensive, why the non-branded bag are so cheap? Because they are selling at a premium and people will buy for it. So this is something to think of. So please don't use price to book less than 1 and hope that you'll go less than 1. It is unlikely, okay, to happen for this Capital DC. If you go below, I think something disaster may happen to Capital DC. Okay, so this is something to take note on that. Okay, and okay, so let's look at their performance. So key part on rating and REITs is first key criteria of choosing REITs is just need to look at DPU. Okay, you can see the DPU is going up. Okay, going up all the way from the year of FY15 to FY20. Actually, it's steadily going up. It's just that they have a huge surge, okay, in last year. Okay, I think during the pandemic period, a lot of people feel that these data centers become more demand and then they earn more income. And because of this huge jump in DPU, which indirectly also causes a share price to jump. As I always mentioned, that if you buy, for those that listen to my REITs talks before, I always mentioned that if a REIT, the DPU keep on going up, the REIT share price will go up. Okay, will sure go up. And with a jump in DPU, the share price will also jump. Okay, this have resulted in Capital DC have been performing so well in the past 3 to 5 years. Okay, and look at this first half. This is the DPU for the first half is 4.9. Okay, this is first half. You just imagine that unlikely the DPU for the second half should be lower than the first half. Unlikely lah. Okay, unless something drastic happen. So it just, let's say it's the same, it's just times 2. You projected their DPU, so will definitely be higher. Okay, will definitely. So it definitely on a growing uptrend. Okay, so this is on the Capital DC dividend side. Okay, so try to look for which DPU go up over the long term. Okay, this will usually benefit you in that, not on the distribution income, not on number of property they increase, not on the MPI they increase. The key focus on risk should be on their DPU. Okay, because DPU is ultimately money in your pocket. Okay, no matter the risk manager, I buy so many property, I buy how many property, no use, because they won't benefit the risk manager. Because they are being compensated by a percentage of how many property they buy. Okay, but you are not being compensated in that way. You are compensated by how much DPU you collected, how much dividend go in your pocket. Okay, so this is what you collected, and this also include if there's an equity fundraising or any fundraising, you didn't participate, you will still not lose out because your dividends still go up. Okay, but you participate, of course, you'll get more lah. So this is what we mean by DPU expect. Okay, so this is what is already happened in the past. Okay, what is already happened in the past. We want to see that does Capital DC have potential to make their DPU going higher and higher in the future. So this is what we want to look at, something called a growth potential. Okay, growth future. And this, what they announced, okay, in something in April this time, actually, they talk about expansion of investment mandate. Actually, this is my personal view. Okay, nothing related to any other personal view. This is my personal view. When actually they expand do this expansion investment mandate, at least let me think. What is the manager trying to do? Okay, what is the trying to do? The expansion of investment mandate means that they will not only buy data center. Okay, do take note, it's a REIT. A REIT must only buy properties. Okay, they say that they now not only will buy data center, they will also buy the ancillary related to the data center. Okay, so this like what subsea cable. Okay, this nothing to do with data center, right? But this is related. So they want to invest in that type of thing. So this made me wonder is, are they running out of idea buying data center? Do they have limitation in buying data center? Which because last year they are very quiet. They only do AEI only, but they didn't buy any data center. And after they announced this mandate, they say that they partner with M1. Okay, M1 is under Capital Corp. Capital DC is under Capital AT&T, but ultimately they will go back to the same boss or the same account, all are called Capital Corp. Okay, and they invest in the SPV vehicle, okay, to go into what? Invest in M1, the fiber cable. Okay, fiber cable asset. Okay, so next question, do they have the expertise on that? Although they say that the mandate will not cost more than 10%, but it's more like, to me, like a distraction. Okay, although they don't do, but you put money there, you have to take care of that. It's more like a distraction to me. So to me, this is not really a positive news. Okay, this is not really a positive news for me on Capital DC. Okay, after that, they say, but they say it's a non-binding agreement. So whether will they pursue going forward? No, I don't know. Maybe because of that, the share price react negatively to them. Okay, after that, they have started to go into China. Okay, they go into China market. So this is another so-called another concern. Okay, going to China definitely is good because they need to expand. And going to China, they're going to buy a data center with a possibility to buy another 5 more data center in China. Okay, but when they reach, but do think it's a new country they're going in. They are in Europe, which is a developed nation. They go to Asia. Australia is also a AAA country. And actually, they are in Singapore, and Malaysia got a little bit. So now they're going to China. China, I think, is a completely ball game. Okay, from complete ball game for Capital DC. So the next question, do they do they know the market well? That one I don't know, but I believe that manager may have do their due diligence on that. Okay, so they're going to in China to buy a data center, and there's 5 more data center going forward. Okay, growing is a good thing, but we need to see how it turn out to be. But fortunately, I think they buy the data center on China is purely on the PowerShell data center. Okay, PowerShell data center is a hands-off data center. So even they don't really have the expertise on China market itself, I think a PowerShell data center will be a good entry for them to go to China market. Okay, later part I'll talk about the different asset class of data center. Some of you may confuse what is called PowerShell. Okay, data center itself is even subdivided into different asset class. So not all data center are the same. Okay, so this is one thing. A good part is they are buying PowerShell data center. So the core and shell data center, I think is okay for them. And after that, they even go to Netherlands, okay, to further acquire Netherlands. But look at the price on the data center by Netherlands, only 37 euro. Okay, so this is what they are going to. And let's look at the price chart. You can see that they have an exponential growth. Okay, do take note. We all say that whatever go up must come down, especially whatever go up too fast. Okay, will need to come down. And actually, this is their lately low trend. I think today is 238. Okay, it's really going into oversold region already. Is Capital DC now the share price is a bit oversold already. Okay, they may be a rebound. They may be rebound, or it is the bottom. I don't know. But if you are looking at long term positive wise, they are still very, data center is definitely very positive. Okay, very positive. And with the current price you go in, your dividend yield will be definitely higher, because otherwise they go too fast and their dividend yield is on the low side. Okay, on the low side, it's not compared with other REITs. On the low side, compared with the peer of data center globally, because data center dividend yield are not high. In the world, you see about not really high, about 4%. But when Capital DC goes so high that the dividend yield become 3%. Okay, which actually they are less attractive compared to the other data center in the world. So now their price has dropped so much that their dividend yield is actually on par with other data center globally already. Okay, you cannot expect a data center REIT to give you 6% dividends. Okay, that one is very, very tough, because the price appreciation of the data center REITs will be definitely there. Okay, so this is currently Capital DC share price. Okay, which I think that is a little bit oversold, but whether the downside will continue or not, we don't know. That will have to depend on what is going forward for what's their game plan for data center. Okay, so this is what my view on data center. Okay, so this is one thing to take note on that. Okay. Wow, there's too many questions already. I think I need to have a pigeonhole for you to ask you not. Okay. Okay, I think all are related to data center. Okay, so what Capital data center going to do? Okay, to buy what in future, all these things are okay, all these are on paper. Okay, we only want to make sure that what is really in futures. Okay, what actually really materialized, that is more important. What they tell you is plan only. Okay, like they okay, what is telling the plan only? So okay, they talk about hyperscale data center. This one we'll talk about that later. But we want to look at, okay, first thing a REITs can't build center. Okay, a REITs can't build. A REITs is not a property developer. Okay, a REITs is not a property developer, so they cannot buy an empty land and build a property up. Okay, you see, they need to buy a ready-made property. Then maybe from there they do some renovation AI to change the properties. Okay, and they can only use about 10% of 15% of their asset to build new properties. So Capital DC is a bit small. It's only $3 billion. Okay, but with the price of data center increasing, so I think very hard for them to develop new data center. Let's say 10% is 300 million. Okay, so when compared other REITs like Ascenders, which actually can build big project on property, we'll talk about that later. So this is on Capital DC. So now we want to look at this REITs. It is called Maple Tree Industrial Trust. Mapletree Industrial Trust is a very strong contender to Keppel DC. I'll share with people that if you want to look at data center, Mapletree Industrial Trust is a proxy to data center risk. It can be one thing that you can consider beside just purely looking at Keppel DC itself. Okay, so what is actually, I think a lot of people will be very familiar with Mapletree Industrial Trust. Just now I talked about the 3-year, 5-year performance. Keppel DC is the top performance. Okay, Mapletree Industrial Trust ranked number 3rd. Okay, in the 3 and 5 year, and Mapletree Logistics ranked number 2nd. Okay, but if you look at 10 years, 10 years, because Keppel DC is less than 10 years, so we don't know the next 5 years. But look at 10 years performance. Mapletree Industrial Trust is the best performance risk. Okay, it's the best performance risk. In terms of 10 years return, you're looking at holding long term. It's the best performance risk in terms of total return in the market. So how many property they have? Okay, this is not updated. Okay, this is not updated. Here say that they have 114 properties over 6 property segment with the AUM at 6.7 billion. But do take note, this is based on 30 of June 2021. Okay, this is based on 30 of June 2021, where is their status now. But this is the updated one where actually they did not officially announce. They did not officially announce because they only do business update and quarterly report every the semi-annual report. So they only do it 3 months once, every 3 months once. So they have not officially announced because as of July, they have bought 29 data center in US. And this is their new AUM. I even write to their IR of Mapletree Industrial Trust, ask them what is the latest AUM. Okay, what's because they just tell me that please use this. Okay, please use this because they have not officially announced what their new AUM, but should be around this range. So their asset, their AUM is 8.6 billion. Okay, but let's focus into their data center side. The data center contribute what? 53%. Okay, 53% of their asset. Okay, and with about 4.6 billion in asset. So how much Keppel DC is 3.1 billion. Okay, 3.1 billion. Okay, they are just purely data center, but Mapletree Industrial Trust data center itself is already 4.6 billion. And of course, they got other side, and they got this is high spec station building. Okay, and this is business park. So these are the two, these are the more what we want, the new industry side. So you can see that data center contribution weightage on Mapletree Industrial Trust is more than half, and it expect to grow further. Okay, you expect to grow further. We'll talk about that later. And this is the 29 data center they buy in USA. So you can see the difference between them and Keppel DC. Keppel DC have been in 2015 have been IPO in Singapore, and they start to buy data center along the way. So since the 7 years, this is 7 years already, they have acquired about 19 data centers. Okay, so they built 19 data centers. Mapletree Industrial Trust was started up with a pure Singapore play REITs. Okay, pure Singapore play REITs, pure Singapore industrial play REITs, exclude logistics. Before that, they only have 4 to 5 data centers in Singapore. Okay, and at 2018, 2019, 2018, 2017, they changed their mandate to talk about data. They want to venture in the data center market. Okay, even before Keppel DC the share price start to rocket up. Okay, and at one go, they should already buy how many? For those that remember, at one time, they just buy 13 and 14 data center. That means just 1 year, 13, 1 year, 14. Within 2 years, they acquired 27 data centers in US. So this is how fast, if they want to grow in data center market, this is how fast they can grow. Okay, so this is the latest data center they have acquired in US in July. And let's look at the number of data centers they have in US. Okay, they have 13, 15, 29. So total they have 57 data center. Okay, total they have 57 data center in US plus 4 in SG. So total they got 61 data center. Okay, so they got 61 data center. But you also look at when come to REITs, we also look at how can they expand. Okay, so how could a REITs that only have know about Singapore market, that have been growing in Singapore market for more than 10 years, because at 2017, 18, then around close to 10 years, then suddenly can go over to US to buy so many data center. Okay, so just like we talk about Keppel DC going to China, do they know about China market? So same thing, we'll ask ourselves, does Mapletree Industrial Trust know about US market? Okay, and apparently I don't think the manager will be know so much about the US market, because they are just focusing on growing the Singapore market aspect. Okay, so this is where when it comes to REITs, the sponsor play a very important role to help a REITs to grow. Okay, how they able to acquire so many data center in US is because purely on the sponsor. Okay, purely on sponsor. The sponsor is Mapletree. We know Mapletree is under Temasek and they have office globally. And especially the first two, actually all the three data center, especially the first two batch of data center, the deal is actually negotiated by Mapletree itself, not the REITs. Not the REITs manager go and negotiate the deal. It's Mapletree go and negotiate a deal to acquire 13 data center, 15 data center. They get the deal ready. Then they just ask the REITs manager, you want data center or not? Okay, you want? Let's do half-half. What do you mean half-half? So they in US, they sell a company. So they buy over 13 data center and 15 data center where everyone take 50% shares. Okay, 50-50 shares. And this is how Mapletree Industrial Trust go into the data center market. Okay, in US. In that aspect. So, and you see what the REITs will do is, you see when we look at the REITs, you want to project whether when is their next equity fundraising or when is their next acquisition. You see when they buy a property that's too big, right, they'll only take 50%. They only take 50%, and their 50% they'll take maybe 1 year later or 2 years later. Okay, so this is what happened to Mapletree Industrial Trust. They buy 50% first, then the next year they buy another 50% of their 15 data center. Following year, they buy the other 50%. So they got 100% of this 15 data center already. So it within 2 purchase. So they buy back from the sponsor. So the sponsor is just something like temporary caretaker. Ultimately, they will pass it to the REITs. And this is how you want to buy a REITs, that we have a powerful sponsor that able to help the REITs manager to grow, especially grow in overseas market. Singapore is really too small. So the sponsor must have the master in overseas to negotiate good deals to help the REITs to grow. Okay. And this is the 86 property in Singapore. You can see this is a data center here. They got actually 3 here and 1 here. So they have 5. I don't know where's the other one. Why missing? They changed it to a, okay, I think they sold it off. So they left only 4 data center. Is also you can see they have 51 data center. Okay, 51 data center. And this is their DPU. Okay, so they have a very impressive track record of growing dividends. You can see since the FY10, then they start to grow the dividend. Okay, and now let's look at this first quarter FY2122. Their dividend have been 3.55 cents. Okay, 3.55 cents. I just want to draw attention to this 3.55 cents. You look at the dividend here is 3.45 cents. Okay, this is when they IPO that time. Okay, you may see, look the same, right? But it is very different. This is 2 quarter dividends. Okay, and this is 1 quarter dividends. Okay, so this is what we mean by growth. Okay, imagine you buy Keppel DC at FY2010 that time, when they over 2 quarters they pay you 3.45 dividend, and you hold this REIT until today, and this quarter this year they pay you 3.55. This is 100% increase of that dividend since IPO. Okay, 100% increase. So you just sit out there, do nothing, the dividend increased by 100%. Okay, 1 quarter is equal to 2 quarters during IPO. So this is what we want to look for REITs, and you can see it is stable. Okay, so you can see that the dividend is more towards a stable rather than go up. There's a spike, then taper down. It is more of a progressive growth. Okay, so when it's progressive growth, there is less shock to the market. Okay, there's less market shock to the market, less shock to the market. And let's look at the share price. Okay, so they have the same fate as Capital DC, okay, where they also go up and come down. Actually, this trend is similar to most of the industrial REITs in Singapore. Why it's more similar is because they have recovered very fast. They have recovered too fast. So while recover too fast, they need to take a break. They think the break rate, then it come down, but it is the graph is nicer than Capital DC. Capital DC is all the way down. This one come down is to go up and come down. Okay, so this is and now actually they are also near their oversold region for Maple Tree Industrial Trust. Okay, for Maple Tree Industrial Trust. But let's look at their growth. Okay, what is their future of growth? Is look at this is their mandate. Okay, their focus is on industrial REITs in Singapore and data center worldwide beyond Singapore. So they are looking to buy data center overseas, okay, globally also. And this is our target. So we are this is mandate just mandate only, but we want to look at their determination, what they want. MIT target for data center to comprise of 2/3 of their portfolio. Okay, which why I say that if you want to buy data center, Maple Tree Industrial Trust can be a proxy to data center. They want currently is about 53%. Okay, their target is to be 2/3, means what? 67%. So there is still a lot of room for them to grow. And we can understand why are they doing that is because their mandate is talk about only Singapore properties. And a risk, if it's purely Singapore play, very hard to grow. Okay, there is a limitation. How much Singapore is so little, how many property can you buy in Singapore? There is a limitation. And you want to look at data center, how many data center can Singapore accommodate? Because data center consume a lot of power supply. Okay, so how much data center can they consume? So they really need to go overseas. So their mandate is worldwide beyond Singapore. So this is what we want. You want to look at data center, you want to look at their growth and their target. And you see when the risk manager tell you this type of target, right? Especially for Maple Tree, the big risk, right? And you see when they tell you the target, most likely they'll hit the target one. Okay, so this is something to think of. And currently, it is one of the largest data center owner among the Asia Pacific. So it is not Capital DC. Okay, it is Maple Tree Industrial Trust. You talk about the largest owner of data center of among REITs are listed in Asia Pacific. It is Maple Tree Industrial Trust and not Capital DC. So this is a very strong challenger to Capital DC when come to data center growth. Okay, so this is something to take note on that. Okay, okay. So okay. Okay. Yes. Okay. Cool. Thank you for the update. They divested the 125 million to Equinix for exercise the option to purchase. That's why they from 5 they cut to 4. Okay. Capital DC and MIT backed by Temasek. Why Temasek favor one over the other? That one is not for me to comment. Okay, but put it the way around. Maple Tree is 100% owned by Temasek. Okay, 100% owned by Temasek. Capital Corp is a listed company, and I think Temasek the most own about 50%. They are 50% owned by the rest of us. Okay, don't worry, the rest of us. And Capital Corp subsidiary Capital AT&T then own the Capital DC. So you go to more layer of change. Okay, and this is so it's not really favor or what. So that one they are running they are indirectly they are competing. That's what Temasek like to do. They come out with Capital Corp, they come out with Sembcorp. Both are on oil and gas fighting against one another. So they come out Maple Tree, which is not listed, and they come out Capital Land. Both are also fighting against one another. Okay, so I think this is healthy competition, so that to keep everyone on their toe, and then they can grow. If only have one, then I think in the end, I think there will be no go because they'll become complacent. Okay, so it's good to have that tile. To me, it's a healthy competition. So because of this, this will keep Capital DC on their toe. Okay, on their toe, because if they don't back up, they will be overtaken. Okay, which is to me is a good thing on that. Okay, so let's look at their growth. Okay, so this is their data center. So we look at growth potential. Do think, as I mentioned, they buy data center, they buy 50%, right? So currently, they got this 13 data center where they bought, I think 2 years ago, okay, with Maple Tree, with the Akong. So the Akong still hold 50%. They have not passed it over to the REITs yet. So means what? the REITs will need to buy over this 50% of the data center. So this is a immediate acquisition we can see in the near term, maybe in the next 1 to 2 years. Okay, this is, but how they're going to buy it, using what method, that one we will not know yet. But this is something that we know that for sure they'll buy. Okay, they will not let the 50% hanging there for too long one. Okay, they definitely will to buy over. Okay, it's similar to land lease. They want to buy over gem, but land lease is too small. They can't makan gem at one go. It's too big for them to swallow. Just like a snake want to swallow elephant, they can't stomach. So they buy bit by bit. They don't buy 50%. They buy small percentage to help them to be out. But ultimately, when they want to makan the whole gem, I think they need to come out with an equity fundraising. No other way. Okay, because the property is too big for them to makan in one go. Okay, and thus this is what you should expect will happen for this coming data center. Okay, then beside US, are they going for other place? Okay, so there is this. The Maple Tree have actually won a contract to build data center, 830 million land tender to develop data center in Hong Kong. Okay, do you think this contract is won by Maple Tree? Okay, they're going to build a data center in Hong Kong. As I mentioned, that REITs are not developer. They don't develop properties. So they need a property developer property. So the sponsor have to be a property developer. Then the REITs can grow better. And Maple Tree is a real estate company. So they're going to develop a data center in Hong Kong. And ultimately, once the data center is done, most likely they'll pass to MIT. Okay, so this may be the first data center that Maple Tree will acquire in Hong Kong. Okay, and the project will complete 2023. Okay, 2023, which is 2 years from now. Okay, 2 years from now. So this is another thing that we can see. Okay, so we want to buy a REIT, we want to know that what we can see. Okay, something just like Capital DC, so that they buy China, then they tell I buy one, I got enough 5 to go into buy. Okay, so it's something that you can see. You want to see growth future and growth potential in the REIT aspect. So this is on Maple Tree Industrial Trust, okay, which is the largest data center, one of the largest data center in the Asia Pacific region. Okay, what about the third contender into the data center space? Okay, will be this REITs called Ascender REITs. Okay, Ascender REITs is the second largest REITs in Singapore, but it's the largest industrial REITs in Singapore. Okay, it's supposed to be the largest, then become number 2 after Capital Mall and Capital Commercial Trust merge. Okay, but anyway, both are under Capital Land. Okay, both are Capital Land. And what they have, they only focus on United Kingdom, US, Singapore, and Australia. Okay, so one thing you can for sure that they unlikely they'll fight with MIT. Okay, unlikely they'll go. Okay, I think their focus on data center will be on Europe side. Okay, this is my personal view, or even Australia side. And also that they have mentioned that they will not go China. Okay, Ascenders will not go to China. And for those that invest Ascender long in time, I think during the initial phase of Ascender, they have property in China. Okay, but I think they sold off all the industrial building in China. So they have no more dealing with China anymore for Ascender REITs. So REITs also start to change strategy along the way. Okay, so this is where they are now for Ascender's REITs. Okay, and this is what their growth. Okay, they will tell that, okay, their DPU. Okay, this is what we also want to look at. All this growth is not relevant to us. This is more practical to us. Okay, more practical that because it's what money in our pocket. So the CAGR for their DPU is 3.6% growth per year. Okay, what do you mean by 3.6%? Means that the dividend growth over the years since 2003 to this year is 3.6%. Okay, look good, but do think not is inflation hedge. Practically, that means their dividend is inflation hedge. Because growing at 3.6% per year, our inflation is about 2.5 to 3%. Means that the dividend you collected for Ascenders is inflation hedge. Okay, not like certain of the company that pay dividend is flat. For example, ST Engineering, they pay the dividend is 15 cents flat. Means that for the past 10 years, you collect dividend 15 cents for ST Engineering. Actually, your dividend drop over time because it is not inflation hedge. It's not increasing dividend. But for Ascenders, the dividend is inflation hedge. So it's 3.6%. Okay, slightly better than inflation. So this is what they grow. Okay, but so this is what they show you. But if you're going to plot the dividend chart of here, you can see that the dividend chart for Ascender is not as nice compared to Capital DC and also compared to MIT, Mapletree Industrial Trust. Okay, but we need to give them some consolation is they are before the global financial crisis. They are the second risk that IPO, second or third risk that IPO in Singapore. Okay, and they've been through the global financial crisis. Mapletree Industrial Trust and Capital DC is after global financial crisis. Okay, so if you were to do a comparison for them after global financial crisis, they are actually also on the uptrend. Okay, they are also on the uptrend. They are also going up. Okay, in fact, they are actually on every year up, year go up and up and up. Okay, however, at 2019, you will see a big drop. Right? Okay, this one don't be too alarmed. It is because they change their financial year. This is 4 quarters of dividend. This is 3 quarters. So it's not they drop. But however, if I were to just extrapolate, it means I take this 3 quarters divided by 3 to make it average out. Then I add in the 4th quarter. Actually, the dividend actually got dropped. Okay, the dividend actually got dropped, and it dropped further. Okay, due to what? The pandemic. But you can see that Capital DC, Mapletree Industrial Trust, despite got pandemic, dividend never dropped and increased. But for Ascenders, a bit different is their dividend have dropped. Okay, have dropped for you can say it's 2 consecutive financial years. Okay, but we expect them to recover. For first half, it's already 7.66. Okay, if we were to extrapolate half, it should be higher than last year. But it may not cross the 16 mark yet. Okay, so this is something to think. So in terms of DPU growth for Ascenders, they are not that attractive compared to Mapletree Industrial Trust and also compared to Capital DC. But one thing is because maybe they are too big. So when a risk grow too big, you can't expect them to every year give you grow and grow and grow. But over long term, it's 3.6% dividend growth over time. Okay, and do think a 3.6% dividend growth. We know that when a REITs along the way, they will do equity fundraising. They call for right issues. They call for placement share offer, right? Okay, so the 3.6% dividend growth, this chart, okay, is that means that you never participate anything, especially for retirees. Because retiree when buy REITs, you worry about they doing equity fundraising. Okay, then you got no money to give them, right? So this is if they didn't do any equity. If you buy the Ascender REITs from IPO and never participate in the equity fundraising, never do anything, your dividends still grow up. Okay, your dividends still go up. Indirectly, you can say that you are not affected by the dilutions. Okay, so this is what we want to look for a REIT. If that you got no money to subscribe, especially for retiree, you want to buy a REIT, your dividends still go up. Even, of course, those can subscribe will have more. Those have subscribed will have more, but you don't have money to subscribe, your dividend will still go up. So this is something you want it when you look for a REIT in the long term, for a longer time horizon for cash flow. Okay, and let's look at what are they going to do. As standards REITs have this year, they also want to go into data center market. Okay, they also decided to zoom in to make data center one of their core assets. Okay, why they want to, okay, you can see why REITs want to go to data center, because data center create a certain form of stability income. Okay, when people buy REITs, they want some income, but they want stability income. So data center indirect create a form, although the yield is low, but they give you stability income. So Ascenders also want to go into that. Okay, and because of their size, just one entry, 11 data center. Okay, just one entry only buy 11 data center and everything in Europe. So they can do a collective purchase at one go. So this is what we mean that size and sponsor very important. Okay, they're able to negotiate deal to get a package deal and grab everything at one go, rather than going one data center buy at one time. I think if 11 data center every year just buy a bit, the cost may be even higher. Okay, the negotiation cost, the everything cost. This is a one-time negotiate at one go 11. Okay, so this is what we mean by Ascenders can be a big contender to Capital DC when it comes to data center play. Okay, because they have the muscle to buy a lot of data center at one go. And this is their data center now in Europe. And with that purchase, you can see the data contribution now take 10%. Okay, take 10%. Okay, it is a 15.9 billion property. 10% means what? 1.6 billion. Okay, it's only 50% the size of Capital DC. Okay, that means if they were to do another acquisition, they'll be on par already. Okay, they were on par. So this is our data center. They have 11, okay, in Europe and 3 in Singapore. So they are not really new to data center. They all the way have 3 data center in Singapore. The Telepark, the Kim Chuan, and 2 at Kim Chuan side. So actually they are not totally unknown. They are not totally don't know about data center. So this is what they purchased on the data center side. And look at their chart. Okay, of course, their chart is not so nice because they have been to a global financial crisis. But one thing you need to look at that is this is a peak and this is a recent peak. They are higher than a GFC price, where you can see a lot of REITs that have been through a global financial crisis. The share price never go higher than that. Okay, the share price never go higher. Like Capital Mall with the CICT, their share price never recover, but Ascenders had recovered. Okay, from the global financial crisis, and in fact, their share price have went higher. Okay, have went higher over the time. Okay, and so this is on the date on the 3 REITs that we're looking at data center. Of course, other REITs also want to enter the data center market. One classic example is CapitaLand China Trust. Okay, CapitaLand China Trust will also be buying data center in China. Okay, but it's only they say only. They have not really take action. Okay, but because the sponsor is CapitaLand, when they say definitely they are going to buy lah. Okay, but I don't think Capital's data center will be their main play for CapitaLand China, but will be also one part of it. So you can see more and more REITs will also want to have a data center piece. Okay, but these are the 3 main REITs that I think will have a big play in data center aspect. So you ask me that you want to buy data center, which REITs should you buy? Okay, which REITs should you buy? Of course, you got money buy all the 3 lah. Okay, which data center would you buy lah? Okay, MIT. Okay, so everyone got different opinion. Okay, but let's say you only one bullet, then you need to choose which one should you buy. Don't just blindly think data Capital DC is the one that is that. Let's buy Capital DC. Okay, let's look further on data center asset class. Okay, so this is not from me. This is from PGIM Real Estate. Okay, I get the source from them. Okay, so data center practically have 3 types of asset class. Okay, so one is called the common one is called the power and shell and power shell and core. The other called power shell and core plus fit out, and the other one called fully operation. Okay, so there are 3 different types of data center. So you want to buy data center, then you need to zoom in to look at these 3 REITs. Actually, what is the data center asset class belong to? Okay, what is power shell and core? Okay, it's just like you buy a properties. Okay, you go and buy a properties, empty commercial building, empty one, empty building. When you buy a property, it's empty. Okay, you buy the property empty. What do you need to do? Rent it out. I mean, I own the building and I rent out the building, but it's an empty building without furniture, without fitting. So this is called shell and core. I only give you the power supply. I only give you the empty building. So you as a tenant move in, what you need to do? You need to do renovation. Okay, you need to do renovation. You do your own. Everything you do your own. And if you see on triple net list, what do you mean triple net list? Triple net list means that you as a tenant, you need to pay for the property tax. When you rent property from people who don't pay property tax, the landlord pay, right? This one, the tenant have to pay the property tax. The tenant have to go and buy the insurance, the fire insurance, the property insurance. The tenant have to take care of the maintenance costs, pipe leak, aircon leak, all this the tenant pay. I as a landlord, I don't need to do anything, but you just need to pay me rent every month. Okay, you just need to pay me rent. So this is called triple net lease. Okay, so this is called a triple net. So when you look at a data center that's on the shell and core, So it's called a triple net lease. Okay. And put it the other way, if you are a tenant, you everything settle yourself, you go and do your renovation, everything, you spend a lot of money doing it, right? Would you want to stay in the property for longer term? Okay, definitely want to stay for longer term, right? So your rent will be long. Okay, you will stay for long-term rent. You ask for long-term rent because I spend so much money already. Okay, so I as a landlord, of course, I'll occur, but I will not ask you. I'll definitely agree you to stay long-term, but you should come with a price thing that escalating rental. That means every year we will build in a rental increase every year, like based on CPI, based on inflation. So it means that I buy the property, I just shake leg, collect money, and I know that my rental will increase every year. Okay, so this is called the shout and call thing. Okay, another REITs that do all this is healthcare REITs. Healthcare REITs, just like Parkway Life. Parkway Life rent out the 3 hospitals, Mount E, Glen Eagle, and East Shore. They rent out the hospital at the 15-year lease, and based on what? Triple net lease also. That means they only Parkway Life REITs only shake leg and collect rental from the hospital every year, and the rental increase every year, which is why Parkway Life REITs, their dividend can only go up, can never come down. Okay, because they are doing in the aspect. So a shell and call, it can relate to the hospital. Okay, it's a similar concept. Okay, so if the REITs focus REITs property on this aspect, then you know that the dividend will sure increase. Okay. So next is called power shell and call fit out. What do you mean by this thing is I buy an empty building, but I do simple renovation. I do some basic simple renovation. Okay, I do some simple. Then after you move in, you need to do something on your own. So you see this type of property will be like double, not really, it will not be triple net lease. We usually will be, sometimes will be double net lease. Okay, means I bear certain costs, but the main cost is still is as a tenant also bear. As a tenant bear more. Okay, so it's something like I rent it to you with minimum furniture. I rent a property to you with minimum furniture. You want more, you buy more. Okay, so this is called a second type of data center. And because of that, the tenant also want to stay long because they also need to spend money to get the thing up to space. Okay, so they want to do that. Okay, the third one is called full operational. Full operation is just that I buy a property, I go and do a full renovation, I put in all the furniture already and ask you to come in straight away, you can stay, you can operate already. So this is called full operation, means that I bear all the risks. I bear all the maintenance costs. I only need to collect, I will collect rental for you, but after a few years, you're not happy, you can move out. Then I need to find another tenant to come over. Okay, so for this one, you see, it's mainly for smaller company also, like for certain staff, they want a data center, then they come and rent from you. Okay, so you see the tenant period will not be long, will be usually shorter, maybe 2 to 3 years. So there is a turnaround. So there is a constantly lease expire, need to renegotiate new lease, or maybe the tenant move out, a new tenant come in. So this is on the full operation side. Okay, so of course that when you come to this side of renting, the renter have to be higher. Okay, have to be higher. This one, the renter will always be the lowest. Okay, so this one will be in the middle. Okay, but this one, the renter will sure increase. Built-in increase. And this one, the rental will definitely increase because the tenant will be long. Okay, the tenant will be on the long side. This one definitely will be on the short side. So this will be high turnaround. Okay, so it depends on, if you are the landlord, depends on what type of property you like. Okay, okay, this is shake leg collect money. This one you need to do a lot of work, but of course effort reward lah. Effort reward. If you can do well, it will earn more. You can't do well, it may earn lesser than this. So these are the 3 types of data center that is in the industry. Okay, the 3 common type of the industry. So let's look at the 3 REITs. Okay, we talk about what are the data center they have. Okay, which category F? Okay, let's look at Capital DC. Capital DC. Okay, so you can see Capital DC, 71% of their rental income is come from who? Co-location. Okay, co-location is the last one. It's a fully operation one. Okay, fully operation one. Okay, and this is fully fitted. This is the second one, rent with limited furniture. This is empty. So empty. So Capital DC is really a data center specialized risk manager because they need to do the operation side. Okay, which explain why their yield is lesser. The yield is 2.8 year. Okay, and you see it's multiple company, multiple tenant. I mean, one building can have multiple company renting it. And you see fully fitted and shell and core is usually one company. And you see you can see 6 year, 11 year. So it's always rent long term. Okay, so this is Capital DC side. So the dividend increase will depend on mainly on this one. They need to renegotiate the deal. So the rental will keep on go up every year. Currently, data center is in high demand, is in shortage, so they are able to capitalize on the market, which why you can see there is a spike in their DPU because they're able to negotiate higher rental. And but can this last forever? So this is something we need to take note. When there is more and more data center globally, okay, there's when they look, will they reach a saturation? We don't know. Maybe 10 years later. Yeah. So this is what Capital DC is. Okay. So next point out to the China data center they are going in. Okay. China's data center they are going, okay, is because they, to me, that's my concern. They don't have China expertise. Okay. So the good thing is about the China data center they're going in is under the shell and core. Okay. That means that they just buy an empty building and they collect rental perpetual. Okay. So this is the China data center. It is not a co-location. A co-location are mainly the Europe data centers. Yeah, mainly the Europe data center. It's very popular in Europe side. So this is the China. So it gives me a peace of mind that when they buy the China data center, at least they start with the shell and core. Okay, their first venture, that means they go in a safer side. Okay, so this is Capital DC. So let's look at Mapletree Industrial Trust. The data center in US. Okay, so this is the 28 data center, not the latest one, the 28 data center. Okay, this is what are they in. Okay, you can see 53% are power shell. Okay, this is fitted data center. So practically they don't have the fully operation data center. They don't have a fully operation data center. Practically they buy the data center is something like minimum furnishing or empty property, and 96% is triple net lease. So the risk manager don't need to fly over so frequently because they just collect rental for long term. Only 3.4% is triple net lease. Also explain why they're able to one time buy so many data center, even they don't have the exposure on US, even they don't have so much experience on data center management because they are buying triple net lease. Okay, they just purely work as a risk manager that purely work as a landlord. Okay, collect rental. Okay, so this is the 28 data center they have bought. And what about the 29 data center they just bought recently after so many years of experience? This is the 29 data center. This is the location. 81% is still triple net lease. 18% is not. Okay, and you can see that they still don't do co-location. Okay, they still don't do co-location. It's either with minimum furniture or it's a completely empty building. Okay, so this is the profile of the 57 data center they have in US. So practically is most of them are just shake leg collect money. Okay, because shake leg collect money, of course the rental income will be lesser, but we know that the rental income is escalating. Okay, so this is what on the data. So depend on what you want. You want more excitement, you want to have potential to have high growth, then Capital DC, the type of data center may be more suitable for you because when they able to negotiate better you, the income will increase. But for Mapletree Industrial Trust is that you know that the dividend will keep on coming every year and will increase yearly, slowly over time. Okay, so this is the Mapletree Industrial Trust data center. Okay, now let's look at Ascenders. Okay, what about the 11 data center that Ascender bought is this category. Okay, you look at the asset type based on income, co-location 37, triple net lease is 63. Okay, so Ascender is in between. Okay, it's in between. Okay, Capital DC more focused to really actively managing the data center. Mapletree Industrial Trust is more like I shake leg collect money, but I collect lesser. Okay, Ascender is in between. Okay, in between in that aspect. Okay, but also that they only have 11 data center in Europe lah. Okay, but most likely the trend for them, I think their trend will still continue be this way when they continue to buy data center. Okay, so this is Ascender data center. So depend on what you like. Okay, next let's move on. We talk about growth future. So I always emphasize that size really matter. When it comes to data center purchase, size really matter. Okay, and this is, you want to get this data, just go to Ascender's website. Okay, they are one of their site. They will constantly update this slide. Why they constantly update that? Because they are the second biggest. They are very proud, so they always update lah. So they tell you they are the number one. So you can see where is Capital DC. Capital DC is here. Where's Mapletree Industrial Trust? Mapletree Industrial Trust. Actually, this is 6 is not updated because it's 8.6 billion area. Okay, so this is Mapletree Industrial Trust. It's the third largest, still lose to Mapletree Logistics Trust. Okay, why size is concerned that we also want to look at growth future. Okay, so this is just to show you. You can see Capital DC is 3 billion in asset. Mapletree is 8.6 billion in asset. Ascender is 15.9 billion in assets. So it's really a giant when Capital DC look at Ascenders. Okay, and let's look at this. I think some of you may have seen this data. I just explained this to those that are not aware. Okay, so there's thing called gearing. A REIT can only gear up to 50%, but of course we don't want them to go 50%. 45% should be the maximum. So if you see a REIT that are gearing cross 45%, just be more careful of the REITs. You may want to ask the fund manager, the risk manager, what he is trying to do. Okay, why go under so high? Okay, it looked like his financial management and capital management may not be so ideal. Okay, it is become, to me, it's a bit over gear. Gearing is good, but over gear is no good. Just like Evergrande, really over leverage until go bust. Okay, so we don't want the risk to cross 45%. Okay, so currently you look at Capital DC is 36.7. Okay, Mapletree Industrial Trust is about 40. This is based on their pro forma of after they buying the data center in US. Because you look at their report, it's only 31. It's a bit low, but actually it's 40%. Okay, Ascender is 37.6. Okay, Ascender is 37.6%. So you look at their headroom. Okay, their headroom Capital DC 453, Mapletree Industrial Trust 735. So when you want to buy a data center, how much does the data center cost? Depends on where they buy. Let's just look at 100 million as an example. Okay, so if Capital DC want to buy a data center, they can only buy 4. Mapletree want to buy, they can buy 7. Ascender, they can buy 21. This is to what? Debt financing. Okay, debt financing. What do you mean by debt financing? It means that they no need to ask you for money. They can buy data center and Capital DC can only buy 4. Mapletree can buy 7. Ascender can buy 21. So we know that this one have to go up over long term. Okay, so imagine if Capital DC want to go and match MIT size. How much equity fundraising they need to do? How much money they need to ask from you for them to buy data center? Okay, so this is something you need to consider of buying REITs also. Okay, so we also buy big REITs, buy bigger REITs, because bigger REITs, when they want to do fundraising, and you see they only need lesser time to ask you for money. Okay, because they got bigger pool, and you want to buy REITs that are always trading above NAV value. Why you need to buy a REIT trading above NAV value? Because when they want to ask money, they can ask lesser compared to REITs that trading at a discount. Okay, this is crucial for retirees. But if you are young and working, I think you don't bother because you got money to pay. But for retiree, because you want the dividend income, you don't want to keep on paying more money for the REITs manager, okay, and for them to grow. Okay, you also want to have a stable income. So this is something to think note on that. And this is current the 3 data. So if you are someone that want to adventurous, want to look for growth, then of course Capital DC may be your consideration. But I want someone that has stability and focus on risk, you know, grow, that MIT may be a consideration. But I want to just buy one REIT that encompasses all the asset class on industrial, I mean warehouse, business city, everything, then Ascenders should be part of your consideration. Okay, so this is something to think of that. Okay, let's look at the price chart. Okay, this is our 1 year return. We can see that all are negative. All the 3 REITs are negative, which indirectly means that it is a positive. You always look at things at both sides. When market come down, ultimately it will go up if it's a good company. Okay, when even a good company go up, the share price will have to come down. So these 3 REITs, the share price have been coming down for the past 1 year. Okay, with who dropping the most capital DC, more than 15%. Okay, but do think this is just based on price return. Have not included the dividend yet. Okay, and this is 2 years with the April low below. You can see that actually Ascender is flat. Capital DC still give a 30% decent return despite the recent downturn. Okay, but let's look longer term. Okay, Maple Tree is in between. Okay, but do think of this exclude the dividend. But you put in a dividend in, actually the return will be closer, but Maple Ascender performance will be still the weakest among these two. Okay, so this is the price chart on these 3 aspects. Okay, anyone so far got any question on this? Okay, if you want us to take, before I continue, I just advertise a bit. Okay, you want us to review a portfolio, you can just scan this QR code and call us, or you want your friend to open an account with us, you just scan this QR code. But anyone got any question on the REITs, on these 3 data center REITs? Okay, so do think no, this is not a recommendation to ask you to buy which of these REITs. All 3 are very good REITs. Okay, it's just based on the personal appetite. If you only have 1 bullet, or you have 2 bullet, or you have 3 bullet, and also depend on the age. Okay, if you are retiree, I usually recommend you to buy bigger REITs. Don't buy the small REITs. Okay, but you are young people, then you got more exposure because you are able to ride the equity fundraising wave for the risk aspect. But try to look for, but you want to have a creative REITs purchase, you see try to buy premium REITs. A discount REITs, you see when you do equity fundraising is usually dilutive. Okay, that one because that is the nature of how REITs game play. Okay, so now let me give me 5 minutes before I wrap up. Okay, so why I always advocate that when you want to make a portfolio, it should be a multi-asset portfolio. Okay, so REITs should be only one asset class, and for retirees, REITs should never be your main portfolio. Okay, REITs should never be your main portfolio. That means it should not be more than 50% of your asset all in REITs. Okay, a lot of people talk REITs for dividend because there's an equity fundraising will eat up thing. The dividend collected may not be enough for you to pay. Okay, thus you always need to have a multi-asset portfolio to build a multi-income aspect, and this is what I mean by multi-income. You need to have something called a guaranteed income, where it can be formed by your CPF life and the retirement plan, and a paycheck where it's the various form of dividend, investment income. And this price out to my cost. Okay, I think a lot of them are my graduate. Okay, but please bear with me. Okay, so but for those that not aware that I'm actually conducting this course called Lifetime Income Mastery. Okay, it is an online course that teaches you how to build a multi-asset portfolio, and REITs is one of the asset class on that. Okay, this course is conducted by me, of course, with 2 co-trainer, and is the IBF course. It's a pre-funded course by IBF. What I mean, 90% of course fee being pre-funded by IBF, and this course is divided into 10 modules. Okay, it divided into 10 modules, 3 parts. So before you want to plan for your dividend income, lifetime income, okay, or investment portfolio, you need to do something is check your own finance. Check your own finance, check where is your leakages, come up with your own personal cash flow and financial statement. Okay, know how to improve your returns by not taking additional risk. Okay, I always like to emphasize that if you can improve your current portfolio or current asset returns without taking additional risk, you already want up already. Okay, you already want up, just like how you improve your savings return from 0.05% to 0.8%. You will increase your dividend by how many times? More than 40 times already. So this is what we mean by check your own finance. And next, we will talk about insurance. As insurance will never make you rich, but you need certain form of insurance to prevent you, okay, to need to liquidate investment when you need money. Okay, so we'll dissect the insurance plan and talk about what are the key insurance plan you need, okay, and don't need to buy too much, and how can it be more cost effective in doing your insurance planning aspect. Okay, and the third module we'll talk about CPF. Okay, CPF, we're not talking only about CPF investment. We also will talk about CPF life, and we'll talk also about how to effectively do your CPF shielding the legal way. Of course, you need to understand the risk. The CPF shielding also not only talk about SA, talk about OA, and also talk about how to withdraw a CPF money. How can you withdraw OA out, then followed by a SA? But there's some risk involved. But if you work good, it may be you may be able to help you, okay, to enhance your return. And of course, we'll talk about SRS. We're not talking about only contribution, okay? We also need to talk about how to withdraw your SRS money over time, okay? And next, we talk about asset class, okay? So do take note, this is a hands-on class. It's not a theory class where you need to do your analysis, okay? So we will talk about six types of bonds. These three, okay, so these three are the guaranteed bond that you you have risk free, and these are the bond that is risk involved. Okay, there is risk involved for these three asset class, and thus you will need to do a bond analysis to make sure that you lose money by buying the bonds. Okay, and of course we'll talk about stocks. We'll only talk about value stocks. Okay, the stocks that give you guarantee, able to give you dividends for income, and we'll talk about how to analyze stocks. Okay, do think that we only talk about Singapore stocks during the course. Okay, we will talk about other style of stocks like foreign stocks, Hong Kong stock only during our graduate class, but the graduate class is only open to Jurong East client. Okay, you're not a Jurong East client, of course, we will not be invited to that monthly gathering session. Okay, and definitely we'll talk about REITs. We'll analyze at least 3 REITs during the class, okay, to look at how to look at REITs and what are the key parameters you need to look at REITs when you want to buy REITs. By doing the analysis, I think you'll know how to analyze the rest of the REITs. And without unit trust, okay, unit trust will be one of the asset class that there's more than 2,000 unit trusts in the market. And unit trust is the only asset class that able to pay you dividend monthly. So we also need to understand how to siphon up the good and the bad unit trust. And this way we will analyze unit trust. Of course, we also do a comparison with the ETFs. Okay, how could ETF come in and how could unit trust fit your retirement portfolio as an asset class? Actually, both is actually required. Okay, if you are looking for capital gain, maybe ETF got good. But looking at dividend portfolio, actually unit trust may be a better option. Of course, we'll also talk about the last asset class, which is the savings and retirement plan, which is capital guarantee. And this will able to form you a baseline for income. Okay, and ultimately we need to put everything together so that you can complete a multi-asset portfolio. Okay, multi-asset portfolio on the aspect. But how to build that is you will need some tools. Okay, so do think, I need to emphasize, this is a course not for everyone. There's 2 basic prerequisites you need. First, you must know how to surf the net. Okay, if you don't know how to surf the net, then please don't attend this class. Well, you will have an issue attending the course, as I will not able to guide you how to click this website, how to click this button on the internet. Okay, number 2, you must know how to use Microsoft Excel. I'm not asking you to do programming, but at least you must be familiar with Excel, how to do plus, minus, times, divide on Excel. So if you've never encountered Microsoft Excel before, please also don't attend this class, as I can't teach you the basic of Microsoft Excel, because I'll give you the Microsoft Excel for you to work on for investment and retirement planning tools. Okay, and I also have a YouTube channel that will actually support the group after the course. Is what I post on the YouTube channel actually is relevant to what you learn. That's why for today's session, I may cut one part and post it on the YouTube channel. So you can just subscribe to the YouTube channel, okay, on that. Okay, and this is a course that's 90% pre-funded by IBF for Singaporean PR. And you're Singaporean, you still have skill future credit not used, you can use a 10% skill future credit to pay for it. Okay, and this is a course date. If you are keen on that, you can just sign on that. You want to know more information, you also can scan this QR code. Okay, you can send this QR code and you are able to get more information on this course. Okay, if not, anyone got any question to ask me? Okay. Okay. If anyone got any question, you can just post your question there, or you can also contact us directly. Actually, this is our team number and this is our email address. You can contact us directly. Okay. If not, I need to end the session because now already 9:30. Okay, because sometimes people complain I overrun. So this is 9:30. If got any question, if not, I will just end this session. And anyone keen on the course, just sign on this link or you can contact us directly. Okay. Now I thank you everyone for attending the course.